definitely an earnings report I was pretty excited for. Starbucks, and this thing popped over 5% after hours. So obviously one we have to dig into today, right? We have to dig into it. Let's take a look at what happened. So obviously I predicted there'd be a decent dip down in terms of sales. I think it goes without saying when you look at companies, really like McDonald's, Wendy's, all these fast food, which again Starbucks is kind of in a different category, but the fast food companies really took a big hit with pandemic right now, as people can't go inside. Not everyone wants to go through drive-through, which I don't necessarily get, but not everyone wants to, right? They want to sit inside, so it takes a hit. Looking at these earnings, though, they are ugly. They're ugly. So, non-GAAP EPS of negative 46 cents, beat by 15 cents, and a GAAP EPS of negative 58 cents, beats by 5 cents. So, I gotta be honest, overall, it's a beat. Now, again, I did think they'd beat on both aspects. I had predicted they would beat on both aspects, and, I'm glad to see they did. Then we look, obviously, at revenue. Both EPS aspects. Revenue they beat on as well, but we're down 38.1% year over year. So they beat by $80 million on that aspect. So they did beat, which I like. I definitely like that they beat on that aspect. I anticipated them to beat. I thought they'd beat by a little bit more. A little bit more. So I'm wrong on that aspect. I can't lie to you. I'm wrong. So I take the hit for that. But overall, comp sales growth was down only 41% versus 42.2 projected. So investors were kind of happy the stock's been beat down. Obviously, if you look at this thing, year to date down 16%. So it was really due for a little bit of upward movement, right? As far as investors are concerned, they're buying in a lot of companies that do a lot worse than this. So Starbucks reports global sales fell 40%. Average ticket was up 23%, and transaction growth was down 51%. So average ticket price was actually up, believe it or not. Average ticket price was up. Comp sales in Americas declined at 41%. To top the consensus, international comp sales were down 37% versus a consensus of 42.5%. So all things considered, they really did beat on every aspect here. I can't lie to you on that. I can't lie to you. And that's why this stock's up. It is an overall beat. Not a beautiful earnings report. You can't say it's beautiful at all. It's ugly. But it's an overall beat. Active membership in Starbucks Rewards fell 5%. Not a shocker at all. Just because the reduced customer frequency, again, as you see. Not a shocker at all. And temporary store closures, a lot of that had to do with it. But only 5% drop in that, not bad. Really not bad. Consolidated operating margin fell to negative 12.6 versus 18.3 a year ago. Ugly, but better than it could have been. Looking ahead, they are giving guidance. That's right. Full year guidance, that is. Full year 2020, they're expecting sales growth, or really decline, of negative 12% to negative 17%, and an EPS of 83 cents to 98 cents versus an 81 cent consensus. So they beat on the guidance on that. So you got to give them credit. They did beat on all aspects of the earnings, EPS, revenue, and guidance. Believe it or not, they beat on all the aspects. So again, investors are buying into it. Definitely not beautiful, but to see a full year profit it's certainly important. Now, it's not enough to cover the dividend. That's something that needs to be concerned, but we'll look at the balance sheet and see what that looks like. This company likes a lot of words, and we don't like a lot of words here. Okay, we don't. We like looking at the fine print. We read the cliff notes here, right? In school, we always just read the cliff notes. It's what we do. Obviously, comp sales partially offset. Look at that average ticket price. So America's comp sales were driven by a 53% decrease in transactions. That's right, over half the transactions were gone. That's incredible. That's just rough there. But you saw an average ticket price increase 27% in the U.S. or in Americas, I should say. U.S. comp sales were down 40%, comp tractions down 52%, with a 25% increase in average ticket. Pretty nice. Overall, 44% less transactions internationally, but a 13% increase in average ticket. So there were benefits there. And if that average ticket stays when they gain those customers back, and again, for the most part, it's really the diehards that stayed with them. So the ones that didn't do it are the ones that don't shop there super often. So that's why you see transactions decrease so much. It's the one-time shoppers every week, but the diehards that go there every day are still going there every day. And that's why they were able to see that average ticket rise, because the regulars, they get the fancy stuff, right? They're not getting just normal coffee. They're getting the fancy stuff. The fancy iced mocha latte, vanilla bean, caramel macchiato, right? I don't know if that's a thing, but I just said it's a thing, so it's a thing. Yeah, I mean, what can I say? What can I say to you there? I mean, let's just be honest with each other here. I think that's the absolute truth. The regulars are raising that average ticket price because they're the ones still going. The non-regulars are not going. So, therefore, you know what I'm saying? The cheaper transactions are weeded out. But the company opened 130 net new stores in quarter 3, which is 5% year-over-year growth. Good to see stores grow, actually. So stores in the U.S. and China comprise 61% of the global portfolio at the end of quarter 3. Net revenues of $4.2 billion declined 38% year-over-year. Blech. You don't like that. You really don't like to see that. What else do we have beautiful-wise? We like to look at things. We don't like looking at the operating loss, okay? We don't like it. Operating loss of $404 million compares to $1 billion in operating income last year. You don't like seeing a $1.5 billion decrease. Still better than Uber in non-pandemic environments. I'm sorry to throw shade. I mean, you know, I'm really sorry for that. But guess what? I just did. I definitely did throw shade. I'm not walking around the room. You're walking around the room, okay? Sometimes we're busy. So, last thing I look at, obviously, we saw the guidance. It looked beautiful. It looked beautiful. Just kidding. It's not beautiful. I'm really sorry. I want to say it's beautiful, but it's better than it could be. It's better than projected, okay? We look at the balance sheet and see what's going on with his dividend, right? Do they have money to cover a dividend that's higher than the current EPS of the year? Well, let's take a look. Let's take a look at this balance sheet. You see this balance sheet? You know what they're giving me? 9 months ending. I mean, every company does it differently. I prefer year over year, but 9 months ending will work. Now, you will notice the company's got a lot more cash than before, $3.9 billion versus $2.6 billion. Good increase in cash. But with all companies, they've been raising debt to increase that cash. I'm going to guess it's the same story here, but we'll take a look. Total current assets of $7.5 billion versus $5.6 billion. So, as far as current assets is concerned, you can tell they can pay out that dividend. Right? They can pay out the dividend, no doubt. Total assets in general of 29.1 versus 19.2. Big increase in total assets. So I have a bad feeling debt's also going to increase quite a bit, and I'm really hoping it doesn't increase by $10 billion as well, because I don't like to see long-term debt increase by that much. Short-term debt, or current liabilities, which I can't speak, is $8 billion versus 6.1. So you see a $1.8 billion increase, where we only saw really a $1.3 billion increase in terms of total assets. Really, well, actually, it was $2 billion. I give him credit. It was just cash that I was looking at. So overall, similar there. Total liabilities went from $25.4 billion to $37.7 billion. So did not increase by the $10 billion aforementioned, but it did increase by nearly $9 billion. So that's, oh my gosh, sorry, I'm dumb. You know, it increased by $12 billion. It increased by $12 billion. I'm sorry. Dumb math. I really thought, I don't know what I was thinking there. I don't know. I thought it said $34 billion. It said 37, and I'm really shocked that it said 37. It's ugly. you really don't like to see that right now there is a pretty large stockholder deficit right now, $8.6 billion in deficit. Not a good time for that deficit. I can't lie to you. So I think there's definitely concerns with this company, and it's not a company I'm going to be buying more into, right? And I really only own 5 shares of this company, so not a position I'm set on. You could see, I don't think you'll see a dividend cut, but for the sake of the balance sheet, they could do it. They really could. I'm not a fan of the company at these levels personally. I know it's down still year to date, but if you look 5 years out, last year was just a tear for this company. I mean, a freaking tear. I like the company way more in the 60s, really preferably 50s. I like it in the 50s. Now, am I going to get it in the high 50s? Probably not. But I prefer it at those levels right now because the P ratio is a little rich, and the dividend yield is somewhat at risk. Pretty rich and risk. Rich and risk. Makes me feel weird saying that, but I really like it. So, I'm not a stock I'm buying right now, for sure. So, I don't know necessarily what to say, What can I say?